Hi everybody, this is Alan Ellman, the Blue Collar Investor. In Lesson 4 of the Beginner's Corner Information Series, we're going to address common sense considerations we screen for in the stock selection process for our covered call writing portfolios. The most important of these considerations is to avoid earnings reports in the current month that we're selling the option. So the rule is never sell a covered call option when a company is reporting earnings in the current contract period. The reason for that is that an earnings report represents volatility or risk. If you have a positive surprise, the price of the stock can go way up. If you have a disappointment, the price of the stock can go way down. Well, if we sell a covered call, we're capping the upside, but yet still susceptible to the downside. So we avoid earnings reports each and every time when we're selling a covered call option. Now, places to find earnings report information, there are many good free websites. The one I'm recommending is earningswhispers.com. We also have earnings dates information on our premium report in the running list section, which I'll show you a little bit later on in this video. The second common sense consideration is to avoid stocks that report monthly same-store sales statistics. In my books and DVDs, I refer to these as banned stocks. And once again, the reason is when these reports come out, they represent risk and volatility, the same as an earnings report. Companies like Walmart, Target, and Costco are a few examples of the companies that report these sales on a monthly basis. Now, these lists are found in my books and on the premium website, but I'm happy to send anybody watching this video a free copy of this list if you email me at alan@thebluecollarinvestor.com. Just put in the header banned stocks and include your name. The next common sense principle is we want to only purchase stocks that have a minimum trading volume of 250,000 shares per day. Stocks that trade with a lower trading volume usually have an unfavorable bid-ask spread, and that means unfavorable trade executions for us. Also, many of these companies are susceptible to manipulation. So we want to make sure that the average trading volume is at least 250,000 shares per day. When we're looking to sell our call options, we would also like to see a minimum open interest of 100 contracts and or a bid-ask spread of 30 cents or less. So let's take a look at an options chain that we showed in Lesson 2. And you see from the red arrow in the middle of the screen is the bid column, and to the right of that is the ask column. If you recall, we sell our options at the bid or the lower price, and we would buy options at the ask or the higher price. The difference is called the spread. In the case of Nuon at the 25 strike highlighted in green, you see that the bid is 75 and the ask is 85. So the bid-ask spread is 10 cents, less than our 30-cent requirement. And if you look at the right-hand side, the column all the way to the right that has the red arrow at the top, you'll see the open interest information. And for that same option, you see over 12,000 contracts show open interest, well above our minimum of 100 that we require. So that information is found on any options chain. The next common sense principle is stock and industry diversification. We don't want any one stock or industry to hurt our portfolio if it turns in disfavor to the institutional investors. So the rule is we want to have a minimum of 5 different stocks in 5 different industries for our portfolio. No one security or group should represent more than 20% of our total portfolios. Our premium running list has industry information. Again, we'll show you that in a little bit. Another way to diversify is to use exchange-traded funds. These are mutual funds that behave like stocks. And we also produce a premium ETF report of the greatest performing exchange-traded funds, and that's produced on a weekly basis for our premium members. Finally, we want to use cash allocation as one of our common sense principles. That means we don't want to have an extensive amount of cash in one particular stock. If we have a stock that sells for $10 and another that sells for $100, we don't want to purchase an equal number of shares because we'll have way more money invested in the $100 stock than the $10 stock. So here's how we do it. If we had a portfolio of $50,000 in cash and we had 5 stocks we were considering, we would allocate approximately $10,000 per stock. Now what we do is we find the price of the stock. In the case of stock A, we see it's $10. So we divide that into the $10,000 allocated per stock, and we would purchase 1,000 shares. Stock B was $20, that would buy us 500 shares. Now I want you to take a look at stock C, which is selling for $30. That would purchase 333 shares. But if you recall, when we're selling options, we need to buy stock in increments of 100. So what we do is we round off to the nearest 100. So in that case, instead of buying 333 shares, we would purchase only 300 shares. And then depending on the number of shares we purchased, that would dictate the number of contracts that we would sell. I'd also like to mention that we also need to have a little bit of cash left over in case we need to execute an exit strategy, a subject that we're going to address in a later lesson. Now I told you I was going to show you the premium report and where some of this information is located for these common sense principles. And on page 1 of the report you see same store sales information and average trading volume. And then if you go to the running list, which is usually located on page 3 or 4 of the report, you see that we give earnings report dates and industry name and rank. So all that information is there for you on our premium report. Or you can go to the free websites that we've mentioned in previous videos. So to summarize, in addition to fundamental and technical analysis, we must also screen these common sense principles. Earnings reports is the most important. We must avoid earnings report in the current month. We must also avoid the banned stocks, the stocks that report same-store monthly sales statistics. We require a minimum trading volume of 250,000 shares per day. We must be diversified regarding stock and industry where no one stock or group represents more than 20% of our total portfolio. And we must have approximately an equal amount of cash allocated to each security in our portfolio. In Lesson 5, we're going to address calculations. Take care, everybody.